ExamPrep.School. Vermont Producer's Life, Accident, Health, and HMO Insurance Exam, exam code SERI ES 14-29. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Annuities, disability income and related, federal tax for health insurance, federal tax for life annuities, general insurance concepts, group health insurance basics, health maintenance organizations, health policy general provisions, insurance regulation, life insurance basics, life insurance policies, life policy provisions, options and riders, medical plans, qualified plans, senior citizen and special needs insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under 8 VSA Section 4E813A, which of the following is required in a producer's application for a Vermont insurance license? A. Evidence of having passed the state licensing exam within the past year. B. Submission of fingerprints and a state and federal background check. C. Certification of professional liability insurance coverage in the amount of $1 million. D. A notarized letter of recommendation from a licensed Vermont producer. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The statute mandates that applicants submit fingerprints for state and federal background checks as part of the application process. Reason A is not correct. Exam scores must be provided separately, but the fingerprint and background check requirement is distinct and mandatory. Reason C is not correct. Liability insurance is not required as part of the application under that statute. Reason D is not correct. Letters of recommendation are not listed among the required application elements. Question 2. What is the standard term length of a Vermont insurance producer license and how often must it be renewed? A. 3-year term with renewal required every 3rd year. B. 1-year term with annual license renewal requirement. C. 2-year term with renewal every 2 years. D. 5-year term with license renewal every 5 years. The correct answer is C. Vermont insurance producer licenses are issued for 2 years and must be renewed biennially under state law. Reason A is not correct. State law does not specify a 3-year term for producer licenses. Reason B is not correct. License terms in Vermont are biennial rather than annual. Reason D is not correct. There is no 5-year renewal cycle for Vermont producer licenses. Question 3. Under Vermont regulations, by what deadline must Beacon underwriters file Rivera's appointment with the commissioner? A. Within 10 business days of the application date. B. Within 30 calendar days of the application date. C. Within 15 calendar days of the application date. D. Within 60 calendar days of the application date. The correct answer is C. The correct answer is within 15 calendar days of the application date, because Vermont law requires insurers to file producer appointments within 15 calendar days after receiving the first application. Reason A is not correct. This option is incorrect because Vermont regulations allow more than 10 business days for filing appointments. Reason B is not correct. This option is incorrect because the required filing period is shorter than 30 days. Reason D is not correct. This option is incorrect because the required filing period is not as long as 60 days. Question 4. According to 8 VSA Section 47(3), which of the following actions constitutes misrepresentation in violation of the statute? A. Stating that a life insurance policy provides a guaranteed cash value at the end of year 5, when it does not. B. Collecting a broker fee higher than the carrier authorized rate. C. Failing to retain continuing education completion records for the required period. D. Denying a claim on the grounds of material misrepresentation in the application. The correct answer is A. The correct answer is that misstating policy cash values misrepresents the terms or benefits of a policy, which is prohibited under the misrepresentation prohibition of 8 VSA Section 43713. The other options involve unfair fees, record keeping, or claim disputes rather than false statements about policy provisions. Reason B is not correct. Charging an unauthorized fee concerns unfair or deceptive trade practices related to fees, not misrepresentation of policy terms. Reason C is not correct. Failing to keep education records relates to licensing record-keeping requirements, not making false statements about coverage. Reason D is not correct. Denying a claim based on fraudulent application information is a claims handling issue, not a misrepresentation at the point of sale. Question 5. A Vermont life insurance agent offers each new policyholder the following incentives upon issuing a $500,000 whole life policy: reimbursement of the first monthly premium, a $75 grocery gift card, and a company logo coffee mug valued at $10. Under Vermont's rebating rules for life insurance, which incentive is permissible? A. Reimbursement of the first monthly premium. B. Giving a company logo coffee mug valued at $10. C. Provision of a $75 grocery gift card. D. Waiver of the policy application fee. The correct answer is B. Vermont law prohibits premium rebates, gift cards, and fee waivers as inducements, but allows promotional items of nominal value, under $25, bearing the insurer's name or logo. Reason A is not correct. Reimbursing a premium constitutes a cash inducement and is prohibited under Vermont rebating laws. Reason C is not correct. A grocery gift card represents a cash equivalent incentive and is disallowed as a rebate. Reason D is not correct. Waiving the application fee functions as a rebate on policy cost and is forbidden. Question 6. Under Vermont insurance producer regulations, which of the following correctly describes the 24-hour continuing education requirement per biennium? A. 24 credit hours per 2-year period, including at least 3 hours in Vermont insurance law and regulations, at least 3 hours in ethics, with up to 12 hours allowed as self-study. B. 24 credit hours per biennium, including at least 6 hours in Vermont insurance law and 6 hours in ethics, with no limit on self-study hours. C. 36 credit hours per 2-year period, including at least 3 hours each in Vermont insurance law and ethics, with up to 12 hours as self-study. D. 24 credit hours per year, including at least 3 hours each in Vermont insurance law and ethics, with up to 12 hours allowed as self-study. The correct answer is A. The correct answer is the option that specifies 24 credit hours per biennium, with minimum 3 hours in Vermont insurance law, minimum 3 hours in ethics, and a cap of 12 hours for self-study, matching Vermont's continuing education rules. Reason B is not correct. Requires 6 hours each in law and ethics and no self-study limit, which exceeds the actual 3-hour minimums and ignores the self-study cap. Reason C is not correct. Specifies 36 hours total instead of the required 24-hour biennial total. Reason D is not correct. Treats the requirement as annual rather than biennial, doubling the actual reporting period. Question 7. Sarah, a Vermont licensed insurance producer, is planning her continuing education schedule for the upcoming license renewal period and must meet the state's minimum ethics CE credit requirement. How many ethics CE credit hours must she complete? A. 2 hours. B. 1 hour. C. 3 hours. D. 4 hours. The correct answer is A. The correct answer is 2 hours because Vermont requires insurance producers to complete at least 2 hours of ethics continuing education during each renewal cycle. Reason B is not correct. 1 hour is insufficient because the state minimum ethics CE requirement is higher than 1 hour. Reason C is not correct. 3 hours exceeds the mandated minimum. Producers only need 2 hours of ethics training. Reason D is not correct. 4 hours surpasses the required ethics CE. Only 2 hours are required by Vermont law. Question 8. Which of the following best distinguishes pure risk from speculative risk? A. Pure risk involves only loss outcomes, whereas speculative risk includes the possibility of gain as well as loss. B. Pure risk is typically assumed voluntarily by the insured, while speculative risk arises from events beyond their control. C. Pure risk involves only the possibility of loss or no change, whereas speculative risk involves the possibility of gain as well as loss. D. Pure risk is often insurable due to limited outcomes, whereas speculative risk is generally uninsurable because of uncertain gains. The correct answer is C. The correct answer is the one highlighting that pure risk only carries the chance of loss or no change, whereas speculative risk introduces the possibility of gain in addition to loss. Reason A is not correct. This is incorrect because pure risk also includes situations where no loss occurs, not solely loss outcomes. Reason B is not correct. This is incorrect because pure risk is not defined by voluntary assumption, but by the absence of any potential for gain. Reason D is not correct. This is incorrect because insurability hinges on risk assessment, not on whether gains are possible. The core distinction is about potential gain. Question 9. A life insurer manages two separate portfolios for annual mortality analysis. Portfolio X contains 500 policies on 60-year-old individuals who all share the same underwriting classification. Portfolio Y contains 50,000 policies on 40 to 45-year-olds with the same underwriting classification. According to the law of large numbers, which portfolio's actual mortality experience is most likely to fall within plus or minus 5% of its expected mortality rate? A. Portfolio X. B. Both portfolios equally. C. Portfolio Y. D. A combined portfolio of X and Y. The correct answer is C. The law of large numbers indicates that the larger homogeneous group, portfolio Y, will exhibit actual mortality experience closest to expected, with less relative variance than smaller or heterogeneous groups. Reason A is not correct. A much smaller block yields greater variance, making its actual mortality less likely to stay within a narrow margin of its expectation. Reason B is not correct. Two groups of vastly different sizes and ages will not both equally match expected experience. The smaller block will deviate more. Reason D is not correct. Combining groups introduces age heterogeneity. Although larger in size, the variance from mixed risk classes reduces precision. Question 10. Under Vermont insurance statutes, how is a domestic insurer distinguished from a foreign insurer? A. A domestic insurer has its principal office in Vermont, while a foreign insurer holds a certificate of authority. B. A domestic insurer is incorporated in Vermont. A foreign insurer is incorporated in another U.S. state. C. A domestic insurer is admitted in its state of domicile, and a foreign insurer is unadmitted in Vermont. D. A domestic insurer writes business solely in Vermont, while a foreign insurer can write business in multiple states. The correct answer is B. The correct description is that a domestic insurer is one organized under the laws of Vermont, whereas a foreign insurer is organized under the laws of another U.S. state. Reason A is not correct. This description is incorrect because the distinction hinges on state of incorporation, not on location of the principal office or certificate of authority. Reason C is not correct. This description is incorrect because admission status is separate from whether the insurer is incorporated in the state or another state. Reason D is not correct. This description is incorrect because the number of states in which an insurer can write business does not define domestic versus foreign status. Question 11. A producer is advising a client about purchasing a life insurance policy from a stock insurance company. Which of the following correctly describes a characteristic of stock insurance companies? A. Policyholders have ownership rights and share in corporate profits through dividends. B. Ownership interests are held by shareholders who receive dividends when declared. C. They always issue participating policies that pay dividends to policy owners. D. Capital is primarily generated through insurance premiums rather than issuing stock. The correct answer is B. The correct answer is that stock insurers are owned by shareholders who may receive dividends when declared, whereas policy owners do not hold ownership interests. Reason A is not correct. Policyholders do not have ownership rights in a stock insurer. Ownership belongs to shareholders. Reason C is not correct. Stock insurers typically issue non-participating policies. They do not always issue participating policies. Reason D is not correct. Stock insurers raise capital primarily by selling stock, not mainly through premiums. Question 12. Which of the following best describes the consideration provided by the insured in a life insurance contract? A. The insured's payment of the initial premium for coverage. B. The insurer's binding promise to pay the death benefit. C. Representations made by the insured in the application. D. The policy owner's reserved rights under the policy terms. The correct answer is A. Consideration in a life insurance contract is the value exchanged by the parties. The insured's payment of premium in return for the insurer's promise of coverage. Other elements such as representations or policy rights are separate contract components. Reason B is not correct. Describes the insurer's promise, which is the insurer's consideration rather than the insured's. Reason C is not correct. Represents the insured's statements, which are part of representations, not consideration. Reason D is not correct. Describes contractual rights of the policy owner rather than something of value exchanged. Question 13. A corporate executive applies for a policy that will pay any civil penalties resulting from future convictions for insider trading. The insurer reviews the application, issues the policy, and the executive pays the premium. Which basic contract requirement does this arrangement violate? A. Offer and acceptance. B. Competent parties. C. Consideration. D. Legal purpose. The correct answer is D. The correct answer is that the contract lacks a lawful objective. Insurance contracts must insure against legally permissible risks, and indemnifying fines from insider trading is illegal and void for lack of legal purpose. Reason A is not correct. The insurer's issuance and the executive's acceptance show that offer and acceptance were satisfied. Reason B is not correct. There is no indication that either party lacks capacity, so the competent party's requirement is met. Reason C is not correct. The payment of premium shows that valid consideration was exchanged. Question 14. In calculating an individual's human life value, what is subtracted from the individual's projected future gross earnings to arrive at the net earnings used in the calculation? A. Federal income taxes. B. Personal living expenses. C. Inflation adjustments. D. Outstanding personal debts. The correct answer is B. The correct answer is personal living expenses, because the human life value method calculates net future earnings by deducting personal consumption costs from projected gross earnings. Reason A is not correct. Federal income taxes are not deducted when calculating net earnings for human life value. Only personal consumption expenses are subtracted. Reason C is not correct. Inflation adjustments do not represent a deduction from projected earnings in the human life value formula. Reason D is not correct. Outstanding personal debts are excluded. Only anticipated living expenses are deducted from future earnings. Question 15. Under the needs approach to determining life insurance requirements, which of the following expenses is classified as a final expense? A. Retirement income shortfall. B. Daily living expenses. C. Children's education costs. D. Funeral and burial costs. The correct answer is D. The correct answer is funeral and burial costs, because final expenses include costs directly associated with the individual's estate settlement at death. Reason A is not correct. Retirement income shortfall pertains to income needs before death, not final expenses. Reason B is not correct. Daily living expenses represent ongoing costs and are not considered final expenses under the needs approach. Reason C is not correct. Children's education costs are not categorized under final expenses in the needs approach. Question 16. Two partners in an LLC enter into a cross-purchase buy-sell agreement funded with life insurance on each other. Which statement correctly describes the tax treatment of the premiums and death benefits under this arrangement? A. Premiums are tax-deductible as a business expense and death benefits are received income tax-free. B. Premiums are not tax-deductible by the partners, and death benefits are received income tax-free. C. Premiums are not tax-deductible and death benefits are taxable as capital gains. D. Premiums are tax-deductible to the extent they exceed the partner's basis in the LLC. The correct answer is B. The correct answer is that premiums for a cross-purchase buy-sell funded by life insurance are not deductible by the partners, while death benefits paid under the policy are generally received income tax-free under IRC Section 101. Reason A is not correct. Premiums paid for buy-sell life insurance are not deductible as a business expense under tax law. Reason C is not correct. Death benefits from a properly structured buy-sell agreement are not treated as capital gains but are income tax-free. Reason D is not correct. Premium deduction cannot depend on the partner's basis in the LLC. Such premiums are simply non-deductible. Question 17. A corporation purchases a $1 million life insurance policy on its key salesperson with the company as beneficiary and pays all premiums. Which statement best describes the purpose and tax treatment of this arrangement? A. It provides employee death benefits. Premiums are deductible as compensation expense and proceeds taxable to the estate. B. It compensates the company for loss of sales revenue. Premiums are not deductible, and death proceeds are tax-free. C. It funds a deferred compensation plan. Premiums are deductible and proceeds taxable as ordinary income. D. It serves as an investment for the employee. Premiums are non-deductible and proceeds are taxable to the employee. The correct answer is B. The correct answer is that key person life insurance indemnifies the company against economic loss from the death of an essential employee. Premiums are not deductible, and death benefits are received income tax-free under IRC Section 101. Reason A is not correct. Key person life insurance is not treated as employee compensation, and premiums are not deductible as such. Reason C is not correct. This arrangement is not a deferred compensation plan. Death benefits are not taxed as ordinary income. Reason D is not correct. The policy benefits belong to the company, not the employee, so proceeds are not taxed to the employee. Question 18. Which information must a producer include on a conditional receipt when accepting a life insurance application premium? A. Date of application and amount of premium paid. B. Proposed insured's date of birth. C. Policy effective date and underwriting classification. D. Beneficiary's social security number. The correct answer is A. The conditional receipt must document the date of application and the amount of premium paid to establish the coverage trigger pending underwriting approval. Reason B is not correct. The applicant's date of birth is part of the application but not a requirement on the conditional receipt. Reason C is not correct. Effective date and classification are determined later by underwriting, not recorded on the conditional receipt. Reason D is not correct. Beneficiary information is recorded on the application, not the conditional receipt. Question 19. According to standard amendment protocols, how should a correction be made to an already signed life insurance application? A. Applicant must initial any amendments made after signing. B. Producer must initial the change and notify the company. C. Underwriter must annotate and resubmit the entire application. D. Company must issue an endorsement reflecting the correction. The correct answer is A. Corrections to a signed application must be initialed by the applicant so that the amendment is authorized by the person providing the information. Reason B is not correct. Producers may witness corrections but are not authorized to initial applicant changes on the application. Reason C is not correct. Underwriters review applications but do not make or initial corrections on behalf of the applicant. Reason D is not correct. Endorsements are used post-policy issue, not for correcting the original application. Question 20. An underwriter reviews an MIB report for a 45-year-old applicant and finds a code indicating a heart murmur that was not disclosed on the application or in medical records. What should the underwriter do next? A. Decline the application based on inconsistency between the health history provided and the MIB report. B. Schedule a paramedical examination to assess detailed physiological indicators related to the flagged code. C. Approve the application at standard rates since medical records show no conflicting health conditions. D. Order an attending physician statement to address the discrepancy flagged by the MIB report. The correct answer is D. The correct action is to request an attending physician statement because the MIB report signals a discrepancy without details, and an APS provides authoritative medical clarification. Reason A is not correct. Declining prematurely without further inquiry is not appropriate. Underwriting guidelines require verification before denial. Reason B is not correct. A paramedical exam collects general health data but does not directly clarify the specific discrepancy noted in the MIB report. Reason C is not correct. Approving without investigating the MIB flag discrepancy risks overlooking material health information. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.